Passive fund pros and cons. Low operational cost result in lower expense. Even buying and selling is simply replicating. There's no less cost of the fund manager. The fund manager is not really involved here. So low operational result in lower expense ratio. Less buying and selling of securities translate to fewer capital gain distribution. Hence, they are more tax efficient, easily manageable, as one does not need to track the performance of the fund or its fund management on a regular basis. You know what the index is, obviously, almost close to the performance of the corresponding index. There's no fund manager involvement as such to outperform that. That's a passive. The risk of underperforming due to individual fund manager decision is lower. Fund manager can't decide, I'll change the ratio. He cannot. Cons. There is no opportunity to outperform the market as passive funds are falling up benchmark. They tend to have higher concentration risk, particularly market cap weighting. Passive investment doesn't allow for customization based on individual preferences. Index, that's what it is. Index 50 stocks. These are stocks that will be on index. Simple. No flexibility to fund measure will lessen impact or market decline. The market goes down, entire stock goes down, so index fund also goes down. The Indian story. Despite the history of 2 decades in India, growth in passive asset picked up only the last 5 years. The last 5 years have been phenomenal for passive investment. The change in the psychology of the entire investor, information availability, learning, education, investor becoming more knowledgeable, it's adding to that. The recent key growth factors are, in 2015, a provident fund trusts were allowed to invest in equities mostly through ETFs. The Employee Provident Fund Organization, EPFO, the largest provident fund in India, chose to invest 15% annual funds via the ETFs. That means by the passive fund. The government's use of E2 to sell stakes in public sector enterprises has boosted passive funds. Uniform categorization by the Security and Chain Board of India has also indirectly contributed to the growth of passive funds. Invest outlook. The market share of passive with the mutual industry, as I said, has grown 1.15 to 17% today. Look at the growth. It's a staggering 53% CAGR, compounded annual growth rate, in the favor of the passive fund. What has led to this? Investor preference. They said the cost is low, expense is low. That's why we invest in a passive fund. 56% is very simple. You just log in. If you're doing an ETF also, your demat account, go online, simply click of a button, it's done. 54% market, they feel that the market has given, India has given better return than any active fund. Selection criteria, 68% they say expense ratio is low. That means I'll get a better return. Let me invest in a passive fund. 58%, the brand of the mutual fund, how large it is, how known it is backed by some big entity brand. 43% fund size. Is it 100 crore, 1,000 crore, 10,000? Larger the better. This is a feel of the investors. Might not always be true, but that's what the investors feel. 34% tracking error. Investor might be better off choosing a fund with a lower tracking error. Passive investment also important. That's a passive investment becoming a very important part of the portfolio. Everybody should have a certain allocation depending on your risk goal and your risk profile, except on your goal, your time horizon, some allocation passive fund also.